In light of the unprecedented impact of the COVID-19 pandemic on Southwest Airlines and the rest of the industry, our company is offering a number of voluntary programs to reduce active pilot headcount. Early in the process, SWAPA SMEs engaged with their counterparts at the company to provide input to these programs, including what was to become the VSP, or Voluntary Separation Program. The last time Southwest offered an early out program was 2009. Known as Freedom 09, the value was so low that it only had a 0.33% take rate among all pilots at the time. Based on that failed opportunity, SWAPA advocated for more generous terms this time around, and it seems Southwest agreed. The VSP offers significant value for many SWAPA members, and we are certain that it will be far more beneficial for our pilots and the company. Before we begin, please remember that all details regarding the VSP are as provided by the company in its documents on SWA Life. This presentation is not financial or legal advice, and SWAPA strongly recommends that you consult with your own financial and legal counsel on your situation and any specific questions you may have. Only active pilots will be eligible to be awarded VSP. Rather than define what an active pilot is for the purpose of VSP, the company has instead defined inactive pilot. An inactive pilot is one who has been on leave or has been absent from work due to an injury or illness for 6 or more continuous months as of June 1st, 2020, or has been on a leave or has been absent from work due to an illness or injury, and, as of June 1st, 2020, that leave or absence is expected, in the company's reasonable discretion, to continue, as the total amount of leave absence would be 6 or more continuous months. So what exactly does that mean? First, were you on a leave of absence which includes an illness or injury of June 1st, yes or no? If no, you're eligible. If yes, then you have to ask yourself, was the leave for 6 continuous months as of June 1st? If yes, you're not eligible. But if the answer is no, then the next question is, does the company reasonably expect the total leave to be 6 or more continuous months? If no, you're eligible. And if yes, you're not. The VSP is structured to offer 3 main components at separation: income and medical benefits, and extended travel benefits. The first component, income, should be considered as 3 parts: the company-paid severance payment, your own qualified monies, and your own non-qualified monies if applicable. So what will be deducted from the severance payment? First, federal and state tax withholdings and FICA, which includes Social Security and Medicare. Medical and dental premiums may be deducted, depending on the selection of the Benefits Plus plan, but remember those are pre-tax premiums, so they reduce any taxable income, and any other monies owed to Southwest. What won't be deducted from severance payments? Union dues, STD/LTD premiums, imputed income from Swagger LOL, and any other payroll-deducted benefit plan options. Some other important points or answers to common questions include the following. Severance payments are not eligible for 401k, NEC, or profit sharing. Any accrued but unused vacation for 2020 and 2021 will be paid at separation. Vacation is an exception and will receive NEC and profit sharing. The TFP rate for severance is based on the rate as of the date VSP starts. Any subsequent changes to TFP rates will not change your rate. VSP is expected to begin prior to our next raise on September 1st, so the rate will most likely be based on today's TFP rates. In the event a pilot passes away during the VSP period, any outstanding VSP installment payments will be paid to his or her estate. In the event of bankruptcy reorganization and the company rejects the VSP, any outstanding VSP amounts will be treated as an unsecured debt and will wait in line to be paid at a pro-rata share of available funds. So we've heard pilots ask, what can I do with my qualified savings accounts if I participate in VSP? Well, you have 3 options. Option 1, do nothing. Both accounts will remain active, although contributions cannot be made because by law they are limited to active employees. Option 2, at separation, consolidate. Roll over the Southwest profit sharing from Empower into your SWAPA 401k at Schwab. Option 3, distribute. Roll monies out of either or both qualified plans, but SWAPA strongly recommends that you talk with an advisor before you do so you don't trigger any unwanted tax events. How should VSP pilots handle qualified distributions? There are many different strategies, and SWAPA cannot offer advice, but required minimum distributions, or RMDs, must commence at age 72. For those who participate in Roth 401k, Those funds are considered part of the RMD calculation. Roth IRAs are not. So a pilot may elect to roll over his Roth 401k monies to a Roth IRA the year prior to the year he or she turns 72. But as a reminder, Roth accounts must be active for 5 years in order for earnings to remain tax-free. If Southwest pays profit sharing in 2020, will a VSP pilot receive payment? Yes, if he or she meets the hours of service requirement of 1,000 hours. A pilot who earns at least 1 TFP per month gets credit for 190 hours of service for that month. With 1,000 hours of service required, a pilot needs a minimum of 6 months to qualify for the year. Wages up to the separation date, plus any paid vacation time, will count toward eligible wages for profit sharing. After 2020, a VSP pilot will not receive profit sharing. Many pilots have money in one or more of our non-qualified savings plans. Participation in the VSP gives you a separation date, which will trigger non-qualified plan distributions to commence per your election. When can I take distribution of non-qualified monies? It depends on the elections you've previously made. The distribution method will either be a lump sum or annual installments over 5 years, and the distribution timing will include taking distributions either the year of retirement or the year after retirement. Many pilots have asked if they can change their elections. The answer is no, because the distribution elections upon enrollment were irrevocable due to the structure of our non-qualified trusts. To find out your choices, go to www.freedomtoretire.com at Empower. While there, you'll be able to enter your bank account information so non-qualified funds can be direct deposited for you. Applicable federal and state taxes will apply. Regardless of what you chose, taxes for non-qual distributions will be withheld at the supplemental rate, which is 22% for federal taxes. No FICA taxes will be paid on the contribution basis, but there will be FICA tax on the earnings portion of the distribution. Moving on from income, medical is the next component of VSP. The specific benefit is dependent on whether the pilot is age 55 or older at the time he or she begins VSP. We'll also review retiree medical benefits provided by CBA Section 14 and explain how they work together. Let's cover 2 issues up front. First, pilots under the age of 55 will only get 12 months of medical coverage under VSP. Number 2, the regular plan is not an option for anyone taking the VSP. So what are the options available for pilots aged 55 or older? Well, they have 2 options. Option 1 is the VSP health coverage paid by the pilot at active rates. Option 2 is instead of VSP health coverage, a pilot may use retiree medical coverage provided by our CBA Section 14. In either case, once a pilot reaches the end of the VSP period, he or she can use sick trips to cover a spouse who has not yet reached age 65. Regardless of your age, the medical and dental plan options are the same. The difference is cost and duration. If you are under the age of 55, you will receive 12 months of company-paid medical and dental at COBRA rates. After that, you will not be entitled to company-provided health benefits. However, if you are age 55 or older, you will continue active medical and dental on one of the Benefits Plus plans shown here for 5 years or until age 65, whichever comes first. After that, you'll have the option of retiree health care provided by CBA Section 14. It's worth highlighting that these Benefits Plus plan premiums are pre-tax premium payments, meaning they will lower your taxable income. Option 2 may make sense for pilots who have large sick banks and don't want to pay medical premiums. However, there are some limitations to be aware of. Per Section 14 of our CBA, a pilot may buy medical coverage at the rate of 10 TFP per month. If a pilot depletes his or her sick bank, the cost of coverage will vary as shown in the table. And if you're age 55 to 59, you must also consider the following. First, you must have at least 15 years of continuous service to qualify, and you will be limited to Choice Plan C and Basic Dental. This chart begins with your age at the start of VSP. If you are younger than 55, you only receive 12 months of coverage under the Benefits Plus plan, but you pay no monthly premiums. At the other end of the scale, if your age is 60 to 64, you will receive Benefits Plus coverage up to age 65 using either Option 1 or Option 2. As a reminder, Option 1 is to pay active pilot rates via payroll deduction. Option 2 is the retiree medical coverage provided by the CBA. You can exchange 10 sick trips per month of coverage for any of the 3 Benefits Plus plans for retiree medical. Option 2 may be a good choice for a pilot who has a large sick bank and wants to avoid paying premiums out of pocket. And it's worth mentioning that trading sick trips for healthcare isn't taxed. It gets complicated if you're between the ages of 55 and 59. Most pilots will probably choose option 1 and pay out of pocket for medical for the first 5 years. After that, option 2, aka retiree CBA rights, begin. And the question is then, does VSP time plus years of service with the company exceed 10 years? If the answer is yes, and you've depleted your sick bank, you'll pay COBRA rates. If the answer is no, you'll pay the age banded rate. If instead a pilot who's 55 to 59 chooses option 2, he may choose to use Choice Plan C only using his sick bank. All the medical choices are very personal and unique. If you have a small sick bank, you may pay the active rates. If you have a high sick bank, it may be advantageous to use the CBA rights and exchange sick trips for coverage. But regardless of your choices of option 1 or option 2, if you started VSP at age 55 plus, and you have a younger spouse that needs coverage to age 65, per the CBA Section 14, you can still trade your unused sick trips at a rate of 10 TFP per month of coverage. And if you deplete your sick bank at that point, you pay the age-banded rate based on the spouse's age. The third and final benefit for VSP participants is the continuation of travel privileges. Eligibility for retiree pass privileges is determined by adding age plus years of service together. If the sum of those two is 65 or more, an individual qualifies. For example, a participant who is age 56 and a pilot with Southwest for 10 years would qualify for retiree pass privileges, since 56 plus 10 is 66. VSP pilots who do not qualify for retiree pass privileges will receive 48 months of pass privileges on Southwest. Because this program is implemented by the company, SWAPA is not the authority to provide definitive responses. Questions should be directed to Southwest. They request that you contact your chief pilot or email pilotqa@winco.com. And it bears repeating, please consult with your own financial and legal counsel on your situation and specific questions you may have.